Let's get more on the increase of credit card usage and the Fed minutes with Deacon Hayes, financial expert. Deacon, thanks for joining us.
Thanks for having me.
Dean, let's start off by focusing on the Fed, and the U.S. Central Bank seems to be focused very heavily on the risk of a global economic slowdown. What's your take on the March meeting minutes?
So they referenced that there was, a recession in Brazil and the weakening of the growth in China. So it's apparent that the Fed is very concerned with the global markets and the impact that that's going to have on the U.S. economy.
Well, what do you think that may mean in terms of Fed action? The Fed did signaling that they may raise rates twice still this year. How likely is that?
I think it's very likely. I think they're just holding back and being very cautious. They know that there's a lot of people watching, and they're making their moves very strategically.
So what's your outlook? When do you expect a raise increase?
I would imagine that come June, it's very possible that they will raise it probably 0.25%, and another probably this fall.
All right, let's say they do raise rates in June. What would that mean for credit card rates?
So anytime the rates are raised by the Fed, it impacts all borrowing, right? So that would mean that credit card rates would increase, which means that you had mentioned the revolving debt. It makes it harder for people to pay off that debt because they're paying an increased rate. Now, it is a nominal increase, but over time, that can be a huge burden on people.
Well, Deacon, that nominal increase could be quite serious, especially in the context that, yes, revolving debt is increasing and American consumers are running up debt again. As we mentioned, consumer loans up 11.2% so far this year, more than double the growth of last year, and close to double the highest pace since 2000, again, according to Bank of America Merrill Lynch. Deacon, why is this happening? What is this signaling?
People are getting more comfortable. It's been about 8 years since the recession, and so money is easier to access. The interest rates are so low, so it makes it appealing to borrow money instead of use cash, and so people are going back to kind of the habits that they had pre-recession.
Is it just a question of perhaps getting a little bit comfortable and forgetting what happened pre-recession, or is it also a question of them not being able to pay for things with cash?
I think there's a mix of both, but I really do think that people are forgetful. We've gone through these type of situations before with the tech bubble and in the 80s. And so what people forget, these type of crises that happen, so they get spend happy, they borrow money to buy things now in hopes to pay for it later. But if we hit a debt bubble and all of a sudden the economy starts going the other direction, people are going to be they're going to be back to recession type worry.
Well, here's a red flag for you. Revolving debt is up around 13%. It's outpacing consumer loans for the first time since the crisis. How much of a concern is this? Why is revolving debt so much more dangerous than your run-of-the-mill credit card debt?
Well, so revolving debt means that they're paying these high interest rates on their debt. And with interest rates low, where you can get a mortgage in the 3%, but you're paying 15% on a credit card, that just makes it hard to get ahead, right? Especially for lower income and middle income families. And so really it is something to be concerned about.
It does look like a history could be repeating itself. According to Card Hub in 2015, consumers in the U.S. amassing around $71 billion in credit card debt, up 24% from the previous year. What do you think this spells? Do you think we could be headed to some kind of credit card debt bubble that could be bursting?
Absolutely, but I think the thing that people are forgetting about is that student loans is almost double that at $1.4 trillion. So really, it's not only the credit card debt, it's just debt in general outside for the consumer.
Okay, so you think that a debt bubble could be brewing?
Absolutely.
Well, what isn't helping is wage growth. It's been stagnant. How much of a factor is this? What needs to happen to boost wage growth?
Yeah, so wage growth, is one of those things where we want to see 3 to 3.5%, and we've been seeing around 2% and less. And so really what we need to see is some reform. We need to see some tax cuts. We need to see some spending cuts, because our debt is basically disabling us from being able to get ahead as a nation. And so we really need to focus on these things.
Okay, we're going to have to leave it there. Thank you so much, Deacon Hayes, financial expert.